excited to welcome you to this first ever Lenders Round Table, which is a collaboration between Property Tribes Financial Services, and the lending community. And this is our inaugural webinar, if you like, and if it proves to be popular, then we hope to do it on a regular basis. So joining me today for our debut Lenders Round Table, I've got Howard and Victoria from Property Tribes Financial Services, and from the lending community we are joined by Alex Witham from LandBay and Paul Ormonde from Quantum. So welcome everybody, and great to have you on the webinar. Howard, let's start with you, because I think a good place to begin would be to give a very brief overview of the mortgage market in November 2023. And clearly we have to mention the disastrous mini budget from September last year. It had a huge impact on finance, didn't it? So could you tell us a little bit about that and how the market is recovering?
Okay, so the current mortgage market is, we're finding ourselves, we're coming out of the other end of an increasing 12 months of interest rate rises, which has caused concern for many borrowers, caused concern for our lender partners as well, as I think that they're trying to allocate tranches of funds to compensate for the rate shock that a lot of borrowers are going to find themselves in as they come out of their 2 and 5 year deals, very low rates 5 years ago, and now look at the standard rates that are being charged and the fees that are being charged as well. So that's causing a lot of people to have uncertainty, and quite a number of people that we speak to are anxious about the huge jump in the mortgage payments that they've got. So it hasn't been helped by the Trussonomics, I think it was called, a year or so ago.
That's a polite version.
Yeah, exactly. I mean, that in itself caused a lot of confusion. I mean, our team were frantically dealing with very anxious clients who were calling us, not knowing what to do. Purchases were put on hold as things got more and more expensive. Refinancing, they were jumping in quickly before rates kept on going up month after month after month. So a lot of forward planning on securing deals way in advance of when they should have been done. We normally do our reviews for our clients who are coming out of, let's say, a 5 year deal. We'll do it at 4.5 years time, so that we've got 6 months to secure the new rate. That's part of our strategy anyway, but people were calling us way in advance of the end of their rate, not knowing what they were going to jump onto and just wanting to secure interest rates before it got so much more expensive. But I mean, the shockwaves went across the market. Even for brokers, we were spending so much more time on one particular case, reapplying, resubmitting, frantically getting the urgent cases in, and then doing it again and again as rates kept on going up and we kept on trying to secure the best deals for our borrowers. And of course, some of our clients, because we are specialists in the buy-to-let sector, they're portfolio clients. So we're not talking about one mortgage at a time here or two mortgages. You know, we were talking 10, 20, 50 mortgages across loads of lenders. So a lot more time was invested, which is our job. I'm not complaining about it, but it's just to, I suppose, clarify that sometimes our work can be a lot more intense than other times. And we seem to be in a period of time now. It's settling. The Bank of England hasn't actually increased their rate for the past couple of times. And so with inflation coming down, the Bank of England seeing that maybe the economy is working the way they wanted it to, and inflation starting to meet its target, as we hope it will do, at least by the end of next year. The interest rates are settling, and in the mortgage market, which is different from the Bank of England base rate, of course, the mortgage market, we are seeing rates coming down, we're seeing fees coming down, we're seeing the buy-to-let stress tests becoming a bit more generous now as well, so that we can get the better lending amounts for our clients as well. So it has been a very, very frantic year since Liz Truss and Quatain brought out, I haven't got words for it, what they brought out, but anyway, what they did had a major impact on all of us, borrowers, lenders, brokers, and we're still coming out the end of it. But this year, I think it's the last 4 months of this year and in the first couple of months of next year, there's, I think, well, I'm sure one of the lender partners will correct me on this, but it's something like, is it 194 million pounds of remortgages or something that need to be done in just these few months, that coming the end of the five-year deals and 2-year deals. I might be way too cautious on that or conservative on that number. I'm not sure, but it's what I'm really alluding to is that everyone that's got a mortgage that's coming to an end of a special offer now, and they've been in that special offer for 5 years or so, there's going to be a rate shock, there's going to be a pay shock. And I suppose what's really resulted is that the need for a professional advisor is even more important now. So we need to be talking strategy. We need to be talking how to plan mortgage payments, how to maybe rebalance the portfolio if we're looking at portfolio borrowers where maybe they've got high loan to values on some properties, low loan to values on the other. Let's rebalance that portfolio to get a better overall value. So there's lots of work a broker does, and it's, yeah, as you say, it's a consequence of the market as a whole, of the politics, the economy, the budgets. We have to take all of that into consideration and do our best to come up with solutions, which is our job. Not always easy, but it's what we do.
Well, the good news is that rates are coming down for buy-to-let below 5% now, and we do have a thread on Property Tribes, which is updated regularly when lenders are decreasing their rates, and it's very nice to see that thread popping back up to the top of the forum because another lender has reduced their rates. And I think you're right, Howard, things are definitely stabilizing, which is so important for landlords because there's so much uncertainty around in our sector. If I could come to Alex first, LandBay is a very well-known lender. You've actually dropped your rates fairly recently. Could you give us a little kind of profile of you as a lender and the kind of client profile you like to attract?
Yeah, absolutely, Vanessa. I mean, we're really trying to establish ourselves as a key player in the buy-to-let sector. We are a buy-to-let only lender, so we're very focused and ring-fenced on our particular sector. So you can be assured that, you know, we certainly like to think we know what we're talking about because it's only one type of product that we lend in. We're doing our best to try and pass on the reduction in swap rates to our landlord customers. And as you rightly said, we've recently reduced our rates, I think, for the third time now in as many weeks. You know, it's difficult for me when someone asks me, what's your best rate? Because they change so often. I often myself can't keep up the pace with it. And when we've got 92 current products, we've got so many choices, you know, sometimes people are spoiled. But we're doing everything we can to try and offer good solutions to our borrowers. A few of the key challenges, Vanessa, at the moment in buy-to-let is, of course, rate shock that Howard alluded to. People are coming off 2% and 3% products, sometimes even lower than that. And you know, they're now realizing their mortgage payments are double or triple what they were prior. You know, if people are coming off a 2% interest-only deal and being presented with a product transfer at 6%, in the main, landlords have their properties on an interest-only mortgage, so that literally means their payments have tripled. So it is difficult. People are trying to navigate the rate shock. Product fees have grown, where lenders are trying to offer, like ourselves, the lowest possible interest rate for a host of reasons, cash flow, and also to try and make affordability stack up. You know, it's something else that the landlords need to consider. The fees have gone up, the interest rates have gone up. However, we're trying to provide a host of choice. We have 5-year fixed rates in the high 4s. You mentioned there's the Property Tribes thread, lenders offering sub 5s. You know, I'm proud to confirm we are one of those. We've got several sub 5% deals. And, you know, a little sneak peek, we're about to drop them again. So when this is published, we'll have another range launched, which will be repriced again. The lower the cost of borrowing, you know, we can essentially look at offering lower rates to our clients. But a big portion of our offering goes out to portfolio landlords, landlords who operate their properties in a limited company name. They make up a good 60 to 70% of our offering. And not every landlord is, you know, Joe Smith with one property in their portfolio. Sometimes it's Joe Smith Incorporated Limited, which is part of another company, which is part of another company. So there's lots of I guess, tools in our toolbox where we can tap into quirky criteria as well as offering some market-leading products. So we're doing our best for the landlords out there, Vanessa, trying to offer flexibility with criteria and a suite of products that tick all the boxes.
Well, fantastic. Thank you for that introduction. That's really interesting to hear what goes on at LandBay, and that, great to hear that rates are coming down again. A bit of a first for our debut webinar, which is always good to see. Let's come over to now Paul Ormonde from Quantum, who's sitting patiently in his car on the, I think, the A406. Paul, tell us, at Property Tribes, we've done some work with Quantum in the past. You're relatively new to the scene. Tell us a little bit about your product offering and the kind of profile of client that you like to attract.
Yeah, so basically, Quantum Mortgages launched, so we're like the new kid on the block. So we literally launched about 18 months ago, as Alex touched on there. So we are specialist buy-to-let only currently. We are expanding into bridging early next year, and we've got our paper in with the FCA to have a residential offering mid to latter part of next year. So we will have obviously a whole host of ranges, and we've also launched a partner sister company in development, which launched about 4 weeks ago. Our target market is the and also I would like to touch also, we are funded by HSBC, which people kind of go, oh my, they're taken aback by. So huge funding line there, and so huge appetite to lend. The target market really is the portfolio landlord. It's probably easier to say what we don't do. So we don't do first-time landlord, we don't do timber frame, and we don't do steel construction. Other than that, literally the whole breadth of property types. We do studio flats of any size. Just on a 13 square meter studio in Chelsea. We did have a 9 square meter, would you believe, in Marylebone, which you did. So again, so I'm not sure if you actually hang yourself up in the door when you open the door. So, so literally any size unit in the country. So all high yielding kind of stuff. And again, appeasing to the sort of portfolio landlord to maybe expand or diversify their portfolio.
Fantastic. Well, maybe I could ask both lenders and indeed the brokers. I would imagine that you're seeing mainly remortgaging, and have you seen evidence that new buy-to-let purchases have dropped off and the business has moved much more to remortgaging? And are you starting to see new purchases coming back? Is anybody able to share any insights into that?
Yeah, I can come in on that if you like. So from our perspective, you're absolutely right. Product transfers and remortgages make up the lion's share. I can see some nodding from Howard, Vanessa, and Paul as well. So there's a lot of that going on. But we are still seeing at LandBay a number of landlords almost seize the current macroeconomic factors to their advantage and use the current state of the environmental economy to leverage lower purchase prices. If a property is on the market at 400,000 and they're searching on Rightmove for properties that have been listed for the longest first, there's a fair shot that vendor is very motivated to shift that property. And if you're a landlord looking to expand your portfolio, of which there are still a lot of those out there, you're going to go in with an offer that meets your commercial criteria. And if you know that 400,000 means your gross yield is not going to stack up, you can't get the funding, or it doesn't meet your personal strategy, but 350 does, you can go in with that offer as your starting point, or lower, depending on how cheeky you want to be, citing current economical factors for why you are offering that amount. And we are seeing exactly that. A large portion of our new business is that of landlords going out there who are sat on their treasure chest of funds that they perhaps extracted when they looked in their crystal ball 18 months, 2 years ago, locked themselves in on 5-year deals at sub 3%. Even with lenders like LandBay, we had sub 3% deals at that time. They are now going out with that war chest of money and being greedy, seizing the day. But certainly remortgages, PTs, the lion's share. But if the deal still works and the numbers meet what they need, we're still seeing a lot of people going out and purchase. Not sure what other people on this call's view is.
No, I have to say I'm having quite a few of the, especially since the interest rates have been coming down, quite a few purchase inquiries. Also landlords looking to sell their own properties in their personal name into their limited companies. I'm seeing an increase in those kinds of inquiries, but definitely cheeky offers on properties that have been on the market for a while, and they are getting accepted.
Yeah.
Yes. Well, I've got a flat in London for sale, and I've had a few cheeky offers which I wasn't happy about, and I didn't accept them. I think, you know, we've talked about you know, landlords being on SVRs in this very to them historically high interest rate environment. I just wanted to say to Paul that Quantum came out with a really, what in my opinion was a helpful product that you were able to offer a like for like remortgage. And I'm so glad that you did this, because if a landlord's managed to maintain the payments over a long period of time at a higher interest rate, it makes sense that they should be able to continue that if they get a better rate. Without any equity release, you've just helped them out with a like for like remortgage. Has that product proved popular?
It has indeed, yeah. I mean, so we launched it again. We actually got a specific product for it now, obviously with the 599 rate. But basically, I said we were finding more and more people now that are on the SVRs. I just took a client, I think it was last week, off together. I think they're on 10.5% on a £1 million loan. So you can imagine.
Ouchie.
Yeah. So it's indeed. So we're getting more and more inquiries. I mean, a lot of the feedback we've had from brokers is like, this is unbelievable that you're actually offering it. And I say all we all require, minimum requirement really is a 2-year term loan, clean history. And I said, obviously, as long as it washes its face at 100%, then actually I said there's no ICR calculation. So yeah, that's obviously growing. I think what we find as well is that because our presence is now growing, more and more people are kind of like, who's Quantum? What they're doing? Are you a term lender? They sometimes think we might be kind of a sort of a bridger type thing. And I'm saying, no, we explain that actually, no, we are, you know, like the likes of the LandBays and those guys there and other lenders in the buy-to-let space, and actually the funding line. Then obviously, say the inquiries and the sort of referrals we're getting from other brokers is fantastic.
Awesome. Well, it's really good that lenders are coming up with solutions in these challenging, you know, sort of market conditions. So we should have really said at the beginning, just to give a disclaimer, that we're not giving financial advice, and we're just having a general discussion about the marketplace. And I think this again highlights the importance of having your broker on hand, and I say almost on speed dial, because some products come out and that they're only there for, you know, a week or something, and then they're withdrawn. And I think, you know, the smart landlord is going to literally have their broker on speed dial. And Howard, you know, I'm always phoning you up.
Well, client confidentiality, I can't say anything, obviously. But
yes, I'm always, you know, on the lookout for solutions. But Howard, you know, there's new products all the time. And if you were struggling with something and your property didn't fit any criteria, 2 weeks later, a new product might come out that you can actually, you know, move forward with. So it is worth having these conversations, isn't it?
always. And working with a professional advisor who's got such a wide reach into the market, we are updated all the time. We get so many emails and calls on a daily basis from all the lenders who want to help us to make sure we're getting the right solutions out to our clients. I mean, Paul and Alex are 2 stars of the industry, so thank you guys for all that you do for us anyway. But yes, we have to be on top of it, of course. Our obligation under our consumer duty and duty of care to our clients is such that we have to always be offering our clients the very best value, the most flexible deals, and we can't just offer a deal and then not talk to you for the next 6 months, 12 months, whatever. We have to be on top of it all the time. But talking about standard rates that you mentioned earlier, I did 5 product transfers for a client yesterday. He's with a lender who I won't mention, but their standard variable rate is 11%. And he's just coming off of 3.75%, which was he had 5 years ago. And even looking at trying to, through the ICR test, the stress tests with other lenders, we couldn't place him anywhere else. So he's had to stay with the lender on a product transfer. But even at 6.84%, I had to suggest that that's better than 11. And even though it's nowhere near the 3.75% that he's already paying, but that's what we have to do. We have to do the full comparison. We have to do the existing lenders offer versus the rest of the market. And we're reviewing it on a daily basis all the time. In fact, remortgage cases that we've had submitted, we've pulled the cases to go back to a product transfer with the existing lender because they've suddenly reduced their product transfer rates, and it's better value not to remortgage, but then to stay with the existing lenders instead. And we're doing those reviews regularly, making sure that our clients always end up with the right solutions.
Mm. And I guess, Alex, we have seen a trend of lenders putting up the product fees. You know, I think we've seen some at 6 or 7%, which is massive, but I can understand why, if you're trying to provide lower rates. That has been a direction of travel in recent months, but I would imagine that's going to kind of reverse now as rates start to come down and kind of normalize. Would you agree with that?
To a degree, yes. It really depends on where is that tipping point of, if we reduce our product fees, you know, when I say we, I mean collectively as an entire group of lenders, we can only afford to reduce those fees when the corresponding APRs will make affordability stack up on the stress testing. So ourselves and most lenders that have got some products with very, very high product fees in comparison to what we're perhaps used to of old, we're doing that with also a choice of higher rates with lower product fees. So I think the variable fee scale product environment will stay for a very, very long time until we start getting swap rates, you know, in the 3s. It's unlikely you will see product fees really start to fizzle out altogether. You know, ultimately there are residential lenders that have joined the party with very, very low, phenomenally attractive rates in the early mid 3s only in the last 2 weeks, but it comes with the baggage of a very high product fee. So it's filtering across both residential prime building society and prime banks, as well as buy-to-let lenders. We're essentially just trying to provide choices, and I think that's the key. Quite often it's important, well, it is important that the client and the broker articulates the total cost to pay analysis over products which have very low rates with very, very high product fees, and the exact contrary. And quite often when you look at the total cost to pay analysis, they are comparable, or in some instances, very, very, very similar indeed. The key consideration to the borrower is ultimately, if you are continually doing, you know, every few years, remortgages with very low rates with very high product fees, you are, especially in buy-to-let, banking on property value growth at quite a rapid rate, because if your property does not accelerate in value and all you are doing every 2 or 5 years is adding large arrangement fees to your gross loan, you could be, you know, inadvertently making yourself a prisoner to that one lender. And if that lender offers a product transfer, great, but not every lender offers a product transfer. So therefore you are a standard variable rate prisoner. And as Howard and Paul have already alluded to, some of those standard variable rates are north of 10%. So yeah, difficult market at the moment, but you know, choices are there.
Well, I'm so glad you pointed that out, because that can be a kind of unintended consequence of these very high product fees. And Victoria, are you seeing any other trends, the way products are going? You know, lenders, obviously they have their stress tests and their underwriting, but if somebody's in a very challenging situation, is it possible to place them with a lender that will, you know, really look at them and try and understand them and try and help?
Absolutely. So we're really, really fortunate that we have representation from our lenders, such as Alex, such as Paul, and other BDMs, but also we have direct contact with underwriters with a lot of lenders as well. So sometimes if you look at it on paper, the case might not look like it fit. However, we speak to the lender, we speak to the underwriter, explain the situation, and sometimes lenders can go outside of their lending policy as such to try and accommodate that client. I always think that lenders want to lend their money. We just need to find the right fit. It's like a jigsaw puzzle. So there's definite, especially in the current market, there's definite lenders that are being a lot more flexible and looking at how they can accommodate those clients.
That's really good to know. And I think it again encourages people to speak to their broker on a regular basis and be aware of new products coming out that could potentially fit for what they're trying to do.
Just as I think Alex touched on his product guide, I mean, we've updated our product criteria and product guide, I think 63 times since we launched, which obviously just goes some way from a new lender. from where we started out. It's and I say we're obviously relatively small compared to a lot of the lenders, and particularly obviously again LandBay here. So to say that we're always trying to evolve, trying to get little quirks. And say I think the touch on about the rates. I mean, I always say, I mean, even if we got a smaller product guide, we don't even talk about the rates. It's all ours is already around the criteria, finding solutions for that portfolio landlord. You know, from a property type to, I don't know, you know, some, let's say again around the criteria from that particular asset they're trying to refinance. So if you actually ask me, I don't know, probably right now what our foreign national rate was, I probably couldn't tell you off the top of my head. I mean, it did change them about 3 weeks ago, but as I say to people here, you're coming to me really to find a solution, and obviously again, hopefully to say a lot more yeses. And I always say trying to shy away from the subject to valuers comments, which just seems to be the dreaded word in the marketplace at the minute.
Yeah, we have been experiencing down valuations for sure, and landlords and surveyors and valuers being super cautious, which that's something I've heard across property tribes, yes, it is concerning, and we've got quite a sluggish market because nothing is really selling, and then we have the whole issue of comparables and not being able to find them. So there are many challenges. Okay, so I thought we'd just move on to talking about fixing a rate, because we're still not certain that the Bank of England is done with their inflation busting tactics, which seems to be the only one that they have. And it's a very common question on property tribes. Should I fix for 2 years, 5 years, 7 years? And now we have some 10-year fixes as well, I believe. I don't know if the panel have a view. I mean, me personally, I always think because of the fees involved and for the certainty, I tend to go for 5 years, or I have done. Probably now I might consider a 3-year fix, but I wondered if anybody had any kind of view on that.
I think it's all about, and this sounds like a sitting on the fence answer, but it is very much down to each individual circumstance. So one thing that we do is we will talk to our clients about what is their long-term strategy, not just about the here and now. In some instances, they have to go, for example, a five-year rate because of affordability. It's, the lender won't give them an option to borrow a shorter time. But if they have got the option to go for like a 2, a 3, a 5, a 10, it's looking at what their longer-term strategy is. Because as Alex has said, they're relying on their portfolio to grow in equity. And if those shorter-term rates have the bigger fees attached, then maybe the 5-year is the better option. So, as I said, a bit of a fence-sitting answer, but it is down to individual circumstances.
I think Tor hit the nail on the head. It's about an individual case, and it's a strategy based on loan to values, based on age, based on future plans. There's so many factors that we have to take into consideration. And the one thing that I mention a lot to my team and to my clients is that we're not product salespeople here. We're not just going to flop a 5-year product. We're advisors. And as you know, Vanessa, I've been running this company just over 30 years now. So we've got clients who have been with me all this time, and they're still with me because we provide an ongoing review service. It's a strategy plan, and we're looking to always make sure that their clients' debts are always properly structured and managed in a way that hopefully gives them the best profit and the most flexibility. I think as Alex earlier said, that not all lenders offer product switches, for example. So, and he's absolutely right. And that's one reason why one client who I was speaking to this morning, we're doing 12 mortgages for him. He won't go with a particular lender because they don't offer product switches, or they don't guarantee it anyway. So it's not solely about the rate and about the amount you can borrow now. It's about what's your plan, as Tor was saying. It's about what is your strategy, and make sure that we treat everything like a business and not product selling. So 5-year deals versus 2-year deals versus 3 and 7s, they all have their place with the right people.
I mean, just to echo that, I think I've been talking to RMD. I mean, because I know a couple of lenders have got the kind of the fix and flex, which obviously, again, where I worked previously, you get the 5-year benefit of the stress test, but you're only tied in for 3 years. And obviously then you've got the freedom to then kind of go, so you get the best of both worlds. So that's something that we're currently exploring, hopefully, but so taking it away with the funders So as I say, you're kind of getting the benefit from the stress, getting the max borrowing, but actually only tied in for 3 years.
Outside of the cost of the actual mortgage financing and the product, the arrangement fees, the other factors that of course need to be considered for those that think a 2-year fix is best is if all they're doing every 2 years is remortgaging to new lenders, not only are there possible arrangement fees and costs directly linked to the product and the mortgaging itself, but quite often people who have their portfolios in a limited company name, that also means new personal guarantees need to be signed. And as a result, they also need to get independent legal advice. Their legal costs need to be factored in. Does the solicitor act on that lender's panel? If not, perhaps you've then got to have one set of solicitors representing the borrower, another set of solicitors representing the client. So all of these things just really drill home why an advisor needs to go through War and Peace. You can't be sat down the pub with your friend Dave saying, I'm going to do a 2-year, you should do a 2-year, because there are so many variables, costs of legals, costs of personal guarantees, arrangement fees, val fees, booking fees. It's everything that you really need a whole holistic appraisal by somebody, a broker, to sit down and go through every circumstance under the sun to make sure that it's completely and utterly right, because what's right for you, Vanessa, might be entirely wrong for me, and same for Tor, and same for Howard and Paul. So there is no correct answer to, is it 2 or is it 5? It is, well, let's have a look at your entire portfolio and work out what's actually the right move for you. Not forgetting that property is a long game. It's very, very difficult to get rich quick, in property. Opportunities are there, but they are few and far between. It's a long game, and you've got to really look at the holistic portfolio and the objectives long term.
No, I completely
you'll be glad to hear that we don't require independent legal advice on an SPV. So obviously, again, so that would negate some costs there, and
Very good.
No PGs below 50%. So again, that should have cut some costs there.
Well, I will take that to my bosses, Paul, and see if we can do something similar.
Well, every penny helps.
I told you the criteria.
I thought we'd just round off our first ever Lenders Roundtable by talking about strategies in the current market conditions. And the two Robs at Property Hub did a podcast recently, and they said, or they listed strategies that they think no longer work. And their view was that lease options, aggressive refinancing, buy to sell, and development no longer work, and that well past their prime are HMOs and holiday lets. And they were of the opinion that the only real evergreen strategies at the moment are to buy and hold for the long term and try and add value. And I thought that was very interesting, and it's sparked a really interesting debate on property tribes. To the lenders, what are your lending kind of USPs for the current kind of market conditions to help landlords strategize and make the most of what can be achieved in these somewhat turbulent conditions?
I'd love to come in on that one first, if that's all right, because we've just drawn down on a fantastic deal only earlier this year. A chap went to auction and purchased an end terraced MUFB. So it once upon a time was a normal house, residential dwelling. The previous owner had developed that into 3 self-contained, fairly small flats. However, they had left it on the same freehold, so there was not individual leases in place. I assume the vendor had unsuccessfully marketed and attempted to sell the property, failed, and placed the property through auction. Our borrower purchased the property for cash. Their strategy, he's a young chap actually in his mid-30s like myself, quite jealous of his net wealth, to be perfectly honest with you, Vanessa. He found this property, purchased it for $335,000, carried out light refurbishment works on 2 of the 3 flats, then positioned it to create new leases on the flats, put all 3 deals to myself at LandBay. They were valued by our surveyor collectively at $450,000 just 2 months after this gentleman acquired this property, which meant LandBay were able to lend 75% loan to value against the 450,000 combined value, which meant, you know, if your maths is very good, that's 337,500. He then financed on a purchase of 335,000. So we actually put 2,500 back in his pocket. So all he has left now in this deal is the equity, his refurbishment and legal and stamp duty, and he's cash flowing 2,675 per calendar month. So deals can still work. I'm not going to say that there's deals by the bucket load at the moment, but they are still out there. You know, I think that really kind of drills home the sort of flexibility that we can offer to provide good solutions at competitive products.
Well done, that young man. Amazing. I wouldn't even know to look for that sort of deal, really. But I think it just shows there's so many different colours and flavours of investors, and everybody's looking at different things. Have you got any thoughts on that, Paul, about what strategies work well in the current market conditions?
Yeah, I mean, what we find, again, in touch on access, again, we will do like a day one refinance off cash, open market value, no work required. So in essence, we had a client, you know, bought it in this morning at auction at 200,000, and come to us this afternoon, and work off the open market value, depending on the property type, up to 80% of the open market value, and not done any work to it. And then what we're finding also is what people are picking up at auction is because we work off very, very low leases. So we'll work off 35 years at end of term. So, you know, in essence, you could buy something at auction that probably ordinarily a lender wouldn't finance at, say, 55 years remaining. And to us, that's kind of bread and butter. And obviously, again, I say you can have a term up to with 35 years at end of term. And again, you can buy that, obviously getting a deal, and then you can refinance that up, and then go again with the property side of things. We're also finding we'll do any size unit in a multi-unit block. So again, a lot of people now are kind of taking units. I just did one 2 days ago, 6 units of 15 square meter units. So you can imagine again, and what they're doing is they're letting those out as holiday lets. So again, very, very high yielding. And they say you are getting a lot more money for your space. Again, as I say, because ordinarily, I know a lot of lenders want 30 square meters as a minimum. So you might only be able to get, say, 4 units out of that, maybe a particular unit. So yeah, so a lot of quirky stuff. So we tend to be, say, all around the criteria. Flats above shops, again, quite high yielding. We do a lot of stuff there. We are finding as well, a lot of landlord shows we've been to, a lot of landlords now are diversifying their portfolios. So again, which is great news for us.
Can I just clarify something there, Paul? When you say the same day remortgage, is that similar to the Mortgage Express product that disappeared around 2008?
Ordinary, yes. Yeah. So I just say you can buy it this morning at auction, and you can come to us as long as the TR1 form is with the solicitor. Then obviously, again, we don't require any land registry showing on there, which again can take up to 6 months within, which obviously defeats the object. So yeah, so you could come to us in the morning, you know, buy it in the morning, come to us this afternoon, in essence, and work off the open market value, which I don't think there's many of them. Yeah, so and I said ordinarily with the short leases, we'll also do virtually any tenancy type in the country. So again, we're finding lots of more landlords now are expanding and putting their properties with sort of vulnerable tenants, assisted living, that kind of stuff there, with a guaranteed rent for some peace of mind. So particularly in the cost of living crisis, they're kind of saying, well, look, I can put it with that landlord, with the council, leave it there for 3 years, 5 years. I mean, someone could actually leave it for, 10 years. We'll do a 10-year, 20-year tenancy.
Okay, well, that's awesome. I guess as we just wind this up then, do we generally as a panel feel that things are improving in the lending market, that more products are going to come out, that more innovative products are going to appear, and landlords can look forward into 2024 with a more kind of settled environment? Is that the way we think it's going?
Definitely. At the moment, our sourcing system can't keep up with the amount of rate reductions that we've got coming on. As Howard said, we get so many emails on a daily basis with lenders lowering their rates that, you know, we can't always pick them up on our sourcing system. So we go to lenders directly to get their rates. We've got fantastic communication from our BDMs about new products that they're bringing out, new lending criteria that they're bringing out. So I'm really looking forward to 2024. I think, you know, the one thing that this whole Liz Truss situation has brought out is people are talking about mortgages because they have to. and people have got a much better understanding of mortgages now, thanks to social media, thanks to things that are going on in the press. Even though some of it is a lot of scaremongering, but it's definitely forced that conversation. And so 2024, I think, is going to be really, really good for people purchasing and for those remortgages and product transfers as well.
I just think if you look at what's happened even in the last 2 or 3 months, Section 21 was announced as being abolished. That's now been pushed back. That's a massive win for landlords. I'm a landlord myself, and to know that that's been pushed back, not indefinitely, it's been delayed until the courts have been improved, is, you know, a massive win for landlords. There's single banding, which was a big issue in HMOs, and I was really listening when you were saying there's a thread on Property Tribes saying HMOs are no longer viable, holiday lets are no longer viable. We still do an awful lot of HMO lending, but absolutely, single banding was a massive, massive fear that was rippling through investors, because if you're doing your number crunching on the basis that you are getting X amount per room for your property, but you think the council may approach you and say your banding is now not on a per house basis, it's on a per room basis, that completely shoots to bits the numbers. But it's been announced very recently, I think in the last week or two, that's now been culled, which is humongous. The EPC upgrades to a C, which was meant to launch in 2025, I believe, 25, has been pushed back 3 more years initially. That's great news for landlords, and I think we're missing that. It's also amazing news for the tenants, because if you were living in a Victorian terraced property with single skin construction that's an EPC E right now, you would be thinking, my landlord may be needing to sell this. So you'd be concerned. And the fact that that's been delayed, you know, pending other factors to come first, is another massive win. Again, all of these factors are very, very recent. Rents are still very high. It's still a good time to invest if the numbers stack up. So deals can still fit. Lenders are trying to innovate. Swap rates are coming down. In the main, we've had an awful lot of positivity in really the wake of what is perceived and perhaps pushed to us on the media at a high level is quite a negative market. But we often miss these little quick wins that come out that actually show that things are getting better. And it's still, if the deal looks right on paper, a good time to invest. So I think there's a lot of optimism. Yes, we've come through, you know, a pretty hellish period over the last couple of years, but you know, the end is in sight. I feel like we're getting very close to that peak where rates are forecasting, and my personal view is, you know, I can see things start to continue to trickle very slowly. You know, anyone who's waiting for an overnight 2% slash on a rate, I think is too optimistic. However, slowly and steadily we're reverting back, to what I can describe as the new norm, because the old luxury rates, I think, are gone for quite some time.
Well, it's so wonderful to end on such a positive note, Alex. I really do appreciate your input there, because there has been so much doom and gloom around, as you say, but actually there are some very positive signs in the market now, which you've very kindly listed there just to remind us, because it is easy to forget. And, you know, I think the fundamentals of property investment hold true no matter what's going on in the marketplace. And a very dear, experienced investor friend of mine said to me, it's not timing the market, it's time in the market. And I think as long as people you know, are taking a long-term view, they're being informed and educated and have the right people around them supporting them, like an amazing broker team like the team at Property Tribes Financial Services, you know, the future's going to be bright, I think. So I just want to thank everybody for joining me on this round table. I've actually learned a lot myself over the last 45 minutes or so, and we'd love viewer feedback. So if you've watched this and you've got value from it, please do let us know. If you've got any questions, please do let us know. We'll endeavour to get them answered. And I'm just going to say to Howard and Victoria, because it was Victoria that kindly came up with this format and brought it all together today. Guys, have you got any final positive notes to end on?
Okay, I'll just add that there's always a solution. There's always the chance for somebody to sit down and talk, not to put their head in their hands and be woe is me because rates have gone up. There's always a solution, product innovation. We haven't even touched on offset mortgages, which reduces the net price as well. There's so many different strategies. Just pick up the phone and talk to us. You know, we're not salespeople. We don't charge for our discussions over the phone. Just talk to us, get things out. A problem shared is a problem halved and all that. But it's also with a positive head on, there's a bright future ahead with the right strategy and the right power team in place, as you say, Vanessa. So between us all, we're here to help, and we're hoping for a very bright 2024.
I agree with Howard. We definitely, there is always a solution. If you're currently on SVR and you're waiting to see what rates are going to do, we always advise to do something now, and we can move that rate down if rates go down. We're constantly, I've probably done about 3 or 4 in the last week, moving people down to a lower rate or to a new lender because those rates have come down. So we work for you, as Howard said earlier. We're not flogging you a product. We're working with you on the right strategy. So if you are on SVR and you're not sure what to do something, and we'll help you with that. And also, if you want to stay on that variable rate, there are some lenders out there that have variable rates with no early redemption penalties. So it means that you might be working on a discount of their SVR or a discount on the Bank of England base rate, but there's no ERC. So you can still save a little bit without being on the SVR, and then you've got the options there.
Fantastic. Well, all that remains is for me to say thank you very much to our panelists today. Thank you to Alex from LandBay and Paul from Quantum, and our 2 mortgage brokers from Property Tribes Financial Services. And we'll put contact details for PTFS below the video. But for now, guys, just to say thank you so much for being part of our first ever lenders panel roundtable. And I've really enjoyed talking to everybody today. And I hope everybody watching has also got value. But for now, we're all saying goodbye, and we hope to see you again on the Lenders Roundtable. So see you soon.